Thank you very much for inviting me. It's fun to give a talk at Sharif University. I've never been to Iran, so it's one of the nice things about the Zoom period we're living in. It's much easier to travel far. This is joint work with Benjamin Junge, former student who works at a hedge fund in Paris now, and Anders Trolle, who is a professor at the Copenhagen Business School. And what we're doing in this paper is we're looking at a new market for credit default swap options, so-called CDX swaptions. And these are options written on credit default swaps. So fairly new market that has emerged after the Lehman crisis and has become very liquid. And what we're doing in this paper is first take a first look, an empirical look at how the quotes and the prices behave in this market. And then we propose a structural model to try to price and evaluate these options. And we're particularly interested in seeing how this model prices these options once it's calibrated to the equity side, so to stock option indices. And so this is why we're looking at this question of relative pricing between credit options and equity options via the index options markets. So what I want to do in this talk is I want to first give you a little bit of an overview of this new market, these new options, some institutional details and knowledge about this market. And then I'll present to you our model, and then how we calibrate it and some of the results about the relative pricing between these markets. That's the roadmap. So just a bit of motivation for why we think it's useful to look at this and what has been previous research on this area. As you may know, if you work on credit or on finance, there's a long tradition of proposing models to evaluate credit risk based on the Black-Scholes-Merton model, the option pricing model. And this tradition goes back at least to Merton, who proposed to view the claims on the assets of the firm, equity and debt claims, as essentially implicit contingent claims on the underlying assets of the firm. Right? So the traditional idea that an equity or a stock price can be seen as a call option on the underlying asset value with a strike equal to the promised payments of debt, and the fact that risky debt can be viewed as risk-free debt minus a put option. However, these first generation models, which were based on the straightforward application of the Black-Scholes model, didn't do so well at fitting the level of credit spread. So once they were calibrated to match roughly the historical default probabilities and recovery rates that one observes on corporate debt, the model implied credit spreads, the yields, if you want, on the debt, on the risky debt, was too low, and that became known as the credit spread puzzle. But however, then subsequent research that enriched these models to allow for more realistic features such as jumps and stochastic volatility in the underlying asset value started to do much better at explaining or predicting the level of the credit spreads that one observes in the data, especially when these models were calibrated to match data on options, stock options, implied volatilities on the underlying firm stock options. And so, for example, in a recent paper in the American Economic Review, Kopp, Nozawa, and Veronesi talk about a great deal of integration between corporate bond and options market. In fact, they propose a model where they use equity options and they extract implied volatilities from equity options, and they use those implied volatilities from equity options in a structural model of corporate debt. And they show that their implied credit spreads predict quite well the actual yields that firms pay on their debt. And they propose to use these synthetic credit spreads as a way to construct histories of corporate debt spreads. So it seems like, based on this, that structural model should do quite well at predicting credit spreads. But the evidence is not uncontroversial. There are a bunch of papers that look at the pricing of corporate bond returns in the spirit of Fama French style models, And what these models find is that actually some of the factors that are used to predict the cross-section of stock returns, such as the classical, let's say, Fama-French factors, book to market, momentum. Well, momentum is not Fama-French per se, but has been adopted in this line of research. So the classical, book to market, size, and market beta related factors, don't seem to do as well at predicting the cross-section of corporate bond returns. And so this literature seems less in agreement about the integration between corporate debt and equity markets. And so from that perspective, this paper we have here today is interesting because it looks at a fairly new market where agents actually trade essentially volatility. They trade options on credit default swaps. And these, when viewed from the lens of a structural model, the implied volatilities implied from credit products, we would think should be very much related to the implied volatility extracted from equity products. And so it's therefore we think interesting to see whether indeed these two markets seem integrated, both just empirically, just running some correlations and doing some regressions, but also through the lens of a more structural model. So that's the plan of the talk. So if I had to just give you a little graph to give you a sense of what we're doing, right? This is a little puzzle here. On the right-hand upper side, you have the classic literature on equity. So that is looking at stock returns. On the left-hand side, you have the literature on credit spreads, that is looking at the pricing of corporate bonds, and thinking about the relationship between these upper two quadrants is essentially this literature on the credit spread puzzle, which is, we have a long history of research that, essentially is called the equity premium literature that sort of has for a long time debated whether stock returns earn too high a risk premium, going back to Shiller and Fama. And then on the left-hand side, we have a more recent literature that says, well, do we see the same type of high risk premia implied in corporate debt? So this is the literature that tries to explain the relationship between corporate debt pricing and equity. And then we have, the whole literature that looks at the relationship between, the upper right-hand quadrant and the left and the right-hand lower quadrant, which is the relationship between equity returns and equity options. And if you want, this is sort of the issue about the out of the money put premium, essentially started after the presidential address of Mark Rubinstein after the '87 crash, right? Suddenly the index options started to exhibit very steep skews, which means, which can be interpreted as, a rejection of the Black-Scholes model, the fact that the implied option volatilities on out of the money put on the stock market seem to be much higher than the implied volatilities on at the money options, which has been interpreted by many as evidence for a crash risk premium, the fact that investors are willing to pay up a lot more to buy insurance on large crashes in the market. So they're paying up in terms of implied volatility quite a bit more. So this is the literature on the out of the money put premium. And what's missing, so far in the literature is essentially left, that missing puzzle piece here, and that's essentially what we're after. We want to also introduce this evidence from this new market. The reason this was missing from the literature is that there was not much data to study implied credit or corporate debt volatilities. But now with this new market, we essentially have quite a liquid market that are option on these credit risk, option on these credit default swaps, and that's going to allow us to essentially study how is higher implied volatilities on credit priced relative to debt, and also how are implied volatilities on credit related to implied volatilities on equity options. And to put some specific institutional names on this sort of general picture I had there before, we're going to focus on these specific financial products. So on the equity side, we're going to look at SPX, so the S&P 500 index, which is one of the broadest U.S. investment-grade equity indices, the 500 largest U.S. firm in this index. We're going to look at the related SPX options, so options on the S&P 500, very liquid large index option market. On the credit side, we're going to look at CDX, which is in the market the closest we can find to the broadest credit default swap index. Unfortunately, and that's something to keep in mind when I go through my talk, is that it's not exactly the same underlying 500 names. The CDX actually is the broad investment grade credit default swap written on 125 large investment grade US companies. So it's not the same 500 names. So it's a little bit of a mismatch here. It would be nicer, it would be a pure experiment if we had options and indices written on the exact same 500 underlying names, or the same 100 names, but we don't have that. We have on the right-hand side the 500 largest US firms for the equity market, and on the left-hand side we have the 125 broadest, most liquid investment grade corporate names. Okay, and then this new market we're going to look at is these CDX options on the CDX, which I'm going to introduce to you if you're not very familiar with them yet in the next few slides. So there's a lot of related literature, some of which I've already talked about, but in the interest of time, I'm going to just skip this unless you have some specific questions about specific papers, given that I want to finish this talk in a sort of timely manner. I'm just going to just let you look at the paper for more detail. Let me instead jump right away into the presentation of the CDX option market. And for that, I just want to give you a few pointers to what is CDX, if you're not very familiar with this market. So CDX is a credit default swap index. So the way you should think about this contract, it's a very liquid contract through which investors can buy protection against default in a basket of 125 investment grade names. So essentially you take some of the largest corporate names in the US that have lots of debt issued. And these 125 names, if you buy a CDX contract, you are essentially protected against the default in this basket. It's an equal weighted basket. So if you have 125, if you buy protection on 125 million, you will have essentially brought protection on default of 1 million of each of these 125 names. And what it means to buy protection is you would pay on a quarterly basis, you would pay an upfront payment and then a quarterly fixed running payment. And if a default were to occur, and the most liquid contracts are typically 5 years, so if within a 5-year window a default were to occur, then you could simply tender to the seller of protection. You could simply tender 1 million worth of notional of the defaulted firm's bonds, and you would receive the par value. So you would receive back 1 million. And so effectively, if the recovery rate of those bonds, if those bonds were trading at, let's say, 60 cents on the dollar, then you would effectively receive a net payment of 40 cents on the dollar. So if you had a 1 million, then you would receive, $400,000. So essentially, that's the way to think about it. It's really an insurance product, and you essentially buy insurance against default in the large baskets of names. Okay. Now, what is the newly introduced option on CDX? Well, as often with options, it's always complicated because you have the right to buy and the right to sell, so the call and the put, and you can buy the right to buy the right to sell, or you can sell the right to buy, sell the right to sell. So you have always these 4 strategies. So in order to avoid confusion, I'm only going to focus on, which is also the most widely used contract. I'm only going to focus on the right to buy protection, so the call option on CDX, and I'm going to particularly focus on an investor who wants to insure himself against default, so who's interested in buying the right to buy in the future protection on this basket. So these so-called payer swaptions, they're essentially an option to, at some future pre-specified date, enter into a CDX contract at some pre-specified strike. So I commit in 3 months to buy protection. I buy the right to, in 3 months, buy protection at some fixed price. And of course, if in 3 months the market conditions have worsened dramatically, then I will be in good shape because I'll be able to enter and buy protection, buy insurance at a price that I determined in the past at a much cheaper price. So, right, so that would exercise my right if credit spreads had widened, okay? And so what I want you to realize, if you're not very familiar with all these types of product, is that to buy the right to buy, so to buy a call option on CDX, from an economic perspective, is very similar to buying a put option on the equity index, right? Because if you buy a put option on the equity index, you essentially buy the right to sell. And so the put option will be valuable to you if there's a market crash, if the equity value of the equity value of the index drops a lot. And of course, if the equity value of the option, if the equity value of the market drops a lot, those are states where you would expect credit conditions to be worse, and where you'd expect credit spreads to be very high. So in the same states of the world where the equity put will pay off, in those same states, holding an out-of-the-money call option on the CDX will be valuable, right? So when the market tanks, equity prices drop, well, you'd expect credit spreads to widen, and so having the right to buy protection at a low credit spread would become valuable, okay? And so what we're going to try to see is, well, how valuable? So what is the amount that people are willing to pay to buy out-of-the-money puts on the stock market? And how does that compare to the amount that investors are willing to pay to buy out-of-the-money calls on credit spreads, right? And this is the economic questions at hand. So first, let me show you some statistics on this market. So it turns out that after the Dodd-Frank implementation, after the great financial crisis and Lehman's default, the Dodd-Frank Act essentially has forced many of these transactions in these sophisticated type of derivative contracts to be sent to data repositories that are publicly available. So you can actually access these data repositories, and you can download data on transactions, and this is publicly available. It's a bit tricky because the format in which the various financial institutions dump the data to these repositories is not always the most accessible. But if you have a good if you're good at scrapping the web or at programming, then it's actually fairly easily accessible, and you can learn a lot about the transactions and the prices in these markets. And so that's what we've done here. Essentially, we've collected data on actual transactions, both in the underlying CDX. This is the first column in this table. So this is trading in the underlying CDX contract. And then the second column in this table is transactions, evidence on transaction on these options on CDX, right? So if you want, the first column is the underlying, the second column is the options, okay? And what you can see if you look at the table, I'm not going to take you through every number, but if you look at this table, you can see that it's a very liquid market, at least in relation, perhaps not if you compare to equity trading, but very liquid if you compare to traditional corporate bond trading. The size of the trades are very large. The size are higher than 50 million and higher than 100 million, because the median trade size actually is at the trade sizes that are reported to these indices, unfortunately, are capped, and the median trade size is actually at the cap. But we can actually infer from certain platforms where we can see the uncapped data, we can actually estimate, and we've done that in a previous paper, we can actually estimate what is the average trade size. The average trade size is around 360 million in the CDX option market, so very large trade sizes. The average daily volume is around 1.5 billion in the options, around 11 billion in the CDX market. So you see quite a sizable and liquid market. And if you look at the table, you'll see that most of the trading, the bulk of the trading, happens in the 5-year most liquid on the run CDX contract and options on that most liquid underlying CDX index. And so this is what we're going to focus on in our study. We're going to focus on the 5-year CDX contract. We're going to focus on the on-the-run CDX, and we're going to focus on call options, so-called pair swaptions on that 5-year CDX contract. Here are some pictures that show you how the previous table were sort of average numbers or median. But you can see that also this market has been growing a lot. So you can see that the charts are just basically going up. The left-hand side is evidence on the underlying market, the CDX, credit default swap index. The right-hand side is evidence on the CDX options. And you can see that the trend is positive. So the volume, both in dollar on the upper panels and the number of trades or contracts exchanged on the lower panel, both these are growing over time. And you can see that they were dramatically high during the COVID crisis. So the COVID crisis, which turned out to be a big shock for credit markets and equity markets, is also a time period where investors were particularly desirable. It was particularly desirable to buy some of these credit option products. Implicitly, these credit options are a cheaper way for you to buy insurance because you don't have to actually pay the full contract. You buy just the right to buy. So it's a cheaper way, a leveraged way for you to buy insurance against further widening in credit spreads, which happened to be very much thought out by investors during the COVID crisis. This evidence here is just to show you, right? There's a broad range of contract specification. You could choose different maturities. You could choose different strikes. And so here, this map shows you evidence on, across columns on maturity, and across lines, it shows you the strikes. In other words, the exercise prices, and this number M is essentially the number of how many standard deviations away from the current forward, from the current spot, if you want, are these strikes traded at. And so what you should look at, and then in the table you have the percentage. So in other words, if you take the lower left-hand number here, 1.42, it's telling you that of all the options that are traded, on average, 1.42% of the options trade with a maturity less than 15 days. So the time to maturity is less than 15 days, and they trade with a strike that's more than 1.5 standard deviation away from the current spot. Okay, so what you should see is that the largest number, they're all in the lower left-hand table, left-hand quadrant of that table, which is to say that most activity in this market currently, this very dynamic market, most activity occurs at fairly short maturity options, so less than 45 days, and for strikes that are very high. So in other words, people are interested in buying options that mature in less than a month, or 2 or 3 months at most, and that have strikes that are very high compared to the current level of spreads. In other words, they're interested in buying protection at a 1 to 3 months horizon against a widening of the spread of more than 2 standard deviations. So they're interested in protecting themselves against large, credit worsening, increases in spreads. Okay, and again, I'm hoping that I'm slowly making you understand this relationship between this market and the market for put options, where also people are worried about, and they're willing to buy in these bad episodes. They're willing to buy protection against the equity index tanking, falling, let's say, by 15 or 20%. This has the similar economic states likely than the one that the agents want to trade when they buy these options on credit. Who is active in these markets? It's hard to get lots of data on that, but this is just a chart that is from some marketing material from JP Morgan. So we don't actually know what's the underlying data there. It's not our data. But what this chart shows is that the sell side, JP Morgan and other banks, basically think that it's roughly divided 50-50 in the interest in these products is roughly divided 50-50 between buy-side firms, i.e. asset managers and hedge funds, and sell-side firms, i.e. broker-dealers and banks. So it seems like there's a two-way market here trading interest between these two types of firms. And I'll say a bit more about why that might be towards the end of my talk. So now I'm going to move towards some stylized facts about prices in this market, and then I'll talk to you about the model. To show you stylized facts about these option prices, I'm actually not going to rely on transaction data. I'm going to rely on the quote data. The reason I do this is that the transaction data, they come in through the day. They're fairly sparse, even though the market's liquid, but they're still fairly sparse. So it's hard for us to get a full picture at any given point in time of the entire implied volatility surface across maturity and strike dimensions. Whereas the quotes we can get from Market, one of the largest provider of data, who essentially merges quotes from several providers, is we can get at a fixed point in time, end of day, we can get the entire range of quotes. So we can get a nice picture of how are market pricing options across strikes and maturity. And so this is just showing you again the quoting activity. So I'm not going to spend too much time on this, but if you look at this color coding, every color corresponds to a certain maturity, and every point corresponds to a quote. So the only thing you should take away from that picture is that quoting activity is happening in the first three maturities, the first three colors from the bottom. You see you get a very full color, meaning that we have at all times quotes across the entire range. Whereas as you go up, the colors start to be less full. It tends to be less quoting activity, so we don't see a full color. The color starts to not be fully there. So we're going to focus on quoting range where we have lots of data. So the first three ranges on that quoting activity. And I already explained all that. So what I'm going to show you now, so as in some stylized facts, is I'm going to show you evidence on the average level of at-the-money volatilities and the slope, or the so-called skew, of the implied volatility surface. And the way I estimate that is we basically run every day across moneyness, a regression of implied volatilities on moneyness, M being the moneyness, which is this standard deviation away from the current spot. And so the estimate of beta 0 will be the estimate of the implied vol we obtain from the cross-section of implied volatilities for an option that has a moneyness of 0. So it's going to be the at-the-money implied vol. And then beta 1 is going to be the slope. How much does implied volatility change as we move away from the at-the-money implied volatility? And this is sort of the evidence. The left-hand side is the credit options. The right-hand side is the equity options. So if you're familiar with the equity options and the puzzles and the out-of-the-money put option prices, then the right-hand picture should be very familiar with you. We have here all the curves in our data set on top of each other. So every curve corresponds to one day. And if you remember, for example, Mark Rubinstein's presidential address, right? It used to be that before the 87 crash, the S&P 500 option implied volatilities were a real smile. They were as high on the left-hand side as on the right-hand side, and fairly flat, actually. And since the 87 crash, that day where the stock market dropped 20% in a day, since that day, the equity markets have been pricing this skew, where the left-hand side of the implied volatility on the options is much higher than right-hand side. And we typically ascribe this to a combination of stochastic volatility, but more importantly, for short-dated options, to the possibility of large downward jumps. And so we can readily infer from these option skews the probability that the market assigns to a large market crash. And if you can see right towards this, if you look at the right-hand picture here, you can see that we have some curves that are high above, right, the other ones. Not surprisingly, I'm sure if I had polled you, you would have given the right answer. These curves correspond to the March COVID-19 crisis, right? That essentially during that period, people became really scared of the potential of a very large market crash. And so implied volatility levels rose a lot, which means people were willing to pay much more to buy protection via put options on the index. And they were also even more willing to pay for out-of-the-money puts, i.e. protection against the crash in the index. So these skew both the overall level of the skew went up, and also it became more negatively sloped, right? And so the left-hand side shows you what we see on these credit options, the implied credit volatilities. And you can see exactly the same thing, quote unquote, exactly in the sense that the slope is, of course, the opposite. It's positively sloped. But if you think a little bit about it, this is exactly what you would expect, because remember, these credit options are optioned on the credit spread. And so if the market tanks, right, if the market conditions are worsened, then we would expect credit spreads to widen. And so indeed, we expect, therefore, an option on the credit spread to be more valuable if credit spreads are expected to widen a lot. So we expect this positively sloped skew, right? So the fact that the left-hand side is positively skewed and the right-hand side is negatively skewed is actually what we expect from the economic perspective, is these two markets are linked. And then, of course, you can see that the same on the left-hand picture. It's also the case that when we had the COVID crisis, you had the overall level of implied volatility widened, and the skew became also steeper. People were more worried about credit conditions getting much worse during COVID, and therefore were willing to pay up to buy insurance on credit spread widening. Okay. Now, the reason we think it's useful to also write a model is that, as you can see, it's very hard if you compare numbers to make sense of these two pictures. On the right-hand side, you see numbers around 0.3 or 0.4, 40%, 30%. On the left-hand side, you see numbers of 60%, 80%, but you cannot tell whether that means that the left-hand market is priced higher, because it turns out the market is not using the same model to quote these implied volatilities. On the right-hand side, the market is using a Black-Scholes model to quote implied volatilities on these equity options. The Black-Scholes model is essentially a model that assumes that the stock price follows a log normal process, which means that the stock price can actually never go to zero, so there could never be any default, actually. So there could never be any default. The left-hand contract would have no value. So the right-hand side, the market consensus to quote options on the S&P is actually completely inconsistent with the model that the market's using to quote the left-hand side products, which essentially is a reduced form model that assumes that default can occur with a Poisson probability. So the two markets used by market participants being not internally consistent, we cannot actually readily compare the 60% we see on average on the left-hand side with the 30% we see on average on the right-hand side, and decide whether one market is pricing more or less risk on average in the market. And therefore, we think it's useful to try to write down a model that's essentially the same model for both markets, and it allows us to extract a number that has the same meaning from both products. Then we can compare these two numbers and say, well, are these markets pricing the same economic states? Are they pricing the same amount of risk? Or is there the same amount of risk premium associated with large crashes from these two markets? So that's essentially the idea behind writing a model that's consistent across these two markets. So, the other things we can look at, and we do in the paper, and I'm not going to take you through every one of these pictures, is we just look at statistically, are these markets related over time? So it's if you want a time series investigation. And the reason we have a 3x3 matrix is that for every market, we have the underlying, so the S&P 500 return, the implied volatility at the money, so the average level of volatility in options, and then we have the skew, the average slope of the surface. And we have that for the equity side, that's going left to right, and we have this for the credit side, that's going up to down. Okay? And so we can look at, is there a relationship between the return on the S&P and the average level of the credit spread? That's the upper left-hand side panel. And you can see, yes, there's a very strong relationship, as you would expect. If the market's doing great, we get a positive return to the S&P, then typically credit spreads go down as investors are less frightened about default risk. So we get this very strong negative statistical relationship between those two markets. The second panel on the first line to the right, that's the classic leverage effect. The fact that when the S&P 500 return goes up, typically implied volatilities on options go down, or vice versa, if you want. If the S&P 500 experiences a crash, then typically the implied volatilities on options go up. That's the so-called leverage effect. And you can see we have a similar leverage effect on the credit side. This is the second line, first panel, which is to say that when the credit spread widens, then typically implied volatilities on credits options go up. this is sort of the mirror image of the leverage effect. So you can see very strong interdependencies between these two markets, which also pushes us to think that, at least looking at this, it seems like the structural model should be able to relate the products, these two products, in an economically meaningful way. Okay, so this is essentially the model we write down, which is in the tradition of the structural models, but it's a slightly richer model. The reason is that we have a more complex setup. We have for every market we have an index, so we have many different firms, right? So let's say the S&P 500, we have 500 firms. Then we're going to try to price the equity side. So we want to be in the tradition of Merton. So we want to write down for every firm, we want to write down the process for the assets of the firm. And then based on the assets of the firm, we want to have for every firm structure of its liabilities. So how much debt it has issued, which we can get information on from Compustat. And then, given that we know its liability, then we can write down the endogenous price for the equity. The equity will be now an option on the underlying asset value with the strike equal to the outstanding debt. So that's going to give us the equity. The debt will be essentially the residual. So it's going to be a risk-free debt minus a put on the underlying asset value. So we're going to have an endogenous equity and debt price. Then we will put all these equities in an index, and on the other side of all the debt in an index. Those are going to give us the indices. These are going to be large portfolios. And then we're going to write options on these portfolios. And so we, of course, have a bit of a rich structure here. So for each firm in the basket indexed by I, we're going to assume that its underlying asset value, AI, follows a log normal process, which has a common component. The common component is this capital A. This is the essentially common asset value component to all firms. And then each individual firm will have idiosyncratic Brownian shocks. These are the WI here, and idiosyncratic jumps, the NIs. And the common component, the A, that's common to all the underlying firms in the basket, has essentially a common Brownian shock that's going to be systematic because it's going to be non-diversifiable across all firms. And it's going to have a systematic jump risk. If you want this, it's going to be the market crash risk, the N. And then in addition, we're going to assume that firms have stochastic volatility that's systematic. So the omega T process is a stochastic volatility process that affects the volatility of the common asset value factor. So we have 100, on the S&P side, we have 500 firms. So we're going to have I running from 1 to 500. So we're going to have 500 AI processes. And in order for us to get explicit solutions, we're actually going to assume that 500 is infinity. So we're going to approximate this by letting n go to infinity and use the so-called large homogeneous pool approximation to get explicit solution. I'll show you how in a few slides. So this is the underlying model. And we're going to price each element in turn. So first we're going to, for one firm, AI, one firm I, given its assets, we're going to price its equity and debt. And again, then we're going to price the index, and then we're going to price the options on the index. So let's first think about pricing the equity and the debt of one firm, firm I. We're going to assume that each firm has a payout ratio delta that goes to equity holders. We're going to assume that each firm has issued short and long-term debt. We want to have two levels of debt because we want to be able to accommodate the term structure of credit, which in other papers we've shown is very important because the term structure of credit spreads tells us something about the market's anticipated Brownian versus jump shocks. So quite naturally, if you had a firm that had very low short-term credit spreads and very high long-term spreads, that would say something about the market's expectation of big shocks in the short term, as opposed to a firm that might have very high short-term spreads and very high long-term spreads, right? You would see that these two firms the perceived probability of a jump by the market would be very different. So in order to be able to accommodate that and calibrate our model to the term structure of credit spreads that may be very different from one firm to the other, we want to have this debt maturity structure. So we're going to assume there's short-term debt, D1, and long-term debt, D2. Okay. Now, this leads to a little complication because we want to solve for the optimal default of the firms. And now the optimal default at date T1 will be endogenous in that firms, when they get to T1, they will owe a repayment of D1, and they will choose to default if and only if the continuation value of continuing to operating the firm until the next 4 years is valuable relative to repaying the debt that's owed at D1. So that actually delivers us an endogenous default boundary where at time T1, the firm will default if the assets is below that endogenous default barrier, and that default barrier will depend on the level of volatility. So we actually have a default frontier, which is endogenous, which complicates matters a little bit. Okay, and then we assume that if a firm chooses to, if the equity holders of a firm choose to default, then the remaining asset value gets paid out to the long and short-term debt holders in proportion to the outstanding notional, which is what one sees empirically, how in bankruptcy court typically the payouts are divided. So again, we're going to price first individual credit and equity, then options, etc. And actually, we're going to get closed form solutions at every step by relying on a new paper. This is new relative to the version that I have given you. We're currently in the process of revising it because we added stochastic volatility, and in order to be able to get explicit solution, we have to rely on a fine Fourier transform analysis. I'm going to give you the details quickly, and this is in a new paper where we're going to have the more details on that technique. But I'm going to give you an overview today. So let's think about pricing. Let's think about pricing debt. The bond, again, the bond value, right, using standard risk neutral pricing would be the discounted value at the risk-free rate of the promised payment D1, and you would receive that payment if and only if the firm would not default, which is meaning if the firm would have an asset value at date T1 that's larger than the maybe here I should use the whiteboard. Sorry, not quite used to this, but right. So the firm would pay you D1 here, right? If and only if it doesn't default, meaning if and only if the asset value is larger than the default barrier, which is endogenous and a function of volatility at T1. And if the firm defaults, the firm will default if the asset value A is less than the default barrier, then you would get a certain recovery, which is a function of the relative notionals. R1 would just be D1 divided by D1 plus D2, and you would get a fraction of the remaining asset value in default, right? So this is sort of classic risk neutral discounting. And we can do the same thing, right? This is just accounting, right? So the long-term debt will get you the promised payment D2 at time T2 if there has been no default at time T1. So no default at time T1 means asset value is greater than the default barrier at time T1, and if the firm value is greater than promised payment at date D2, right? And of course, you would get recovery in case the firm defaults at date T1, which would be here. That's if the firm defaults at date T1, meaning if the firm asset value was less than T1 than phi T1 at T1, then you would get a recovery at that time, or you might get some recovery if the firm had not defaulted at T1 by default at time T2, right? So you can see you can go through the accounting, and so you can figure out all the other formulas in the same way. And you can see that in order to value and to get expressions for the debt values, what we need is solve these conditional expectations. So we need to solve things that look like, right, this conditional expectation here, right? And these conditional expectations, you can see that essentially they depend on, if you didn't have the A terms here, they would just be expectation of indicator functions. So they would be joint, cumulative probability. They would be joint probability distributions, right? Cumulative probability distributions. And then with the A, well, it complicates things a little bit, but that's just a change of measure in some sense. And so you can essentially try to compute these conditional expectation by using either, for the case where there's no stochastic volatility, that you can actually brute force calculate these joint probability distributions. And for the case where there is stochastic volatility, then in order to calculate these joint probability distributions, you need to rely on multivariate Fourier inversions, which is what we do in the paper. Okay, and so we can also, in the same way that here we calculate the value of debt and the value of equity, we can also value the credit default swap. The credit default swap would essentially just be the protection component. So the debt, right, would give you cash flow rights to the principal. The credit default swap is just stripping the value to the principal and just retaining only the payments, insurance payments, but the analysis is similar, right? So if you know how to price the corporate debt, that as I showed you on the previous slide, then you also know immediately how to calculate the value of the credit default swap. So the issue is once we have now the value of the debt and the value of the equity and the value of the credit default swap, we want to think about how to price the credit default swap index. And so what is the credit default swap index? Well, the credit default swap index is just, in the case of the CDX, is 125 individual credit default swaps. So we can really think of it as an equal weighted portfolio of 125 credit default swaps. So that means the upfront payment on the CDX, this upfront payment on the CDX index, is an equal weighted contract, N would be 125 in the CDX, of individual CDSs on each firm. Now, of course, in our case, we want to have an analytic solution, so we use this really nice idea of Vasicek 87 called the large homogeneous portfolio assumption, and we essentially take the limit as the n goes to infinity, and then the idea of Vasicek is to say that given the stochastic structure we have on the underlying asset value, each firm's asset value, we can see that if we condition on the common state, and the common state is going to be this X here, which encodes A, the common asset value component, and omega, the common volatility component. If we condition on X, then conditional on X, each of the underlying asset values are IID. And that means that when we take this limit as n goes to infinity of this sum, we essentially get an average. And so we can use the lower large number to essentially estimate this the limit of this sum as just an expectation of the individual CDS, again, conditional on the common state, okay? And so when we do a little bit of algebra here to calculate this conditional expectation, we can get a nice expression for the upfront on the index. So we can get an analytic expression for the upfront on the index. Now notice that again, calculating this upfront, we need to compute these, the typical conditional expectation. And these conditional expectations, they're not entirely easy to compute, but for the case where there's no stochastic volatility, the AIs are going to be all mixtures of log normal random variables, so we can get analytic expressions in terms of sums of 1- and 2-dimensional cumulative Gaussian distributions. For the case where there's stochastic volatility, then it turns out we can actually get analytic expressions also for every one of these conditional expectations. For the case where the default barrier, the log default barrier, is linear in volatility, which is at the bottom of the slide here. So for the case where, so turns out that this approximation here to assume that the log barrier is linear in omega is actually a very good approximation. So we do this in the paper numerically. We verify that this is actually very accurate. And so for our paper, this is what we're going to rely on. And I can show you, since you're engineers, I can give you a bit more sense about how we calculate this conditional expectation using multivariate transform analysis. Now, it's a bit rough, the slides I'm going to show you, because it's quite technical. But I think you guys are an engineering school, so I would never show this if I was presenting this to sort of my MBA students, for example. But this, if I can do it here somehow, maybe I shouldn't go out of the whiteboard mode. No. Okay, it doesn't work. Okay, it doesn't work. So normally, if I had a PDF file, I would click on this, and it would get me to the analytic solution. Let's see. But I can do it. I can do it brute force. So let me do it this way. I was at slide 29. All right, here we go. So I just want to show you, because you guys are engineers, so you might enjoy this. If not, then bear with me a few minutes. But I want to show you we're quite happy with this new result. So how to compute this typical conditional expectation using Fourier inversion. So you can see here at the top, we define this expression right? Which is essentially this conditional expectation. So the idea is, given some affine process X, okay, X is a general n-dimensional affine process, like in our case, asset value and volatility together. Given some X process, we want to calculate this conditional expectation, where you can see the first component is essentially the asset value A in most in our application, and then the second component is this indicator function. And it turns out that we can prove that to calculate this conditional expectation, you can estimate it recursively, solving this expression here. Okay, so essentially we can show that the this U function, which is defined up here, encodes recursive expressions that correspond to these conditional expectations for different ends, and this U function can be recovered from the inverse Fourier transform of the characteristic function of the joint characteristic function of the random variables that are essentially in the indicator function. We can think of essentially each of the the expression in the indicator function, these betas here. We can think of each of these expressions as they are a random variable, and if we can calculate the joint characteristic function of these random variables, which are sums of affine variables. So if we can calculate the joint characteristic function, then we can recover the joint cumulative distribution of these n random variables by using multivariate inverse Fourier transform. And that's what essentially this theorem is showing. And so essentially, if you have, if you had only one, if n was equal to 1, that would be a one-dimensional cumulative probability distribution we want to estimate. Then we would get a one-dimensional, inverse Fourier transform. If we want to estimate the joint probability of 2, so if n equals 2, then we will have to do a two-dimensional inverse Fourier transform of the joint characteristic function, etc. And so this theorem shows exactly how to estimate using this approach, this conditional expectation. And maybe it's a bit messy, but the point is, once we've encoded once we have encoded how to inverse this joint characteristic function, then solving these conditional expectations we have in the main text, such as here or here or here, is just essentially using this previous theorem, and we have analytic solutions for the joint characteristic function. So it's very amenable to implementation, especially if you're good engineers, which my co-authors, thank God, are. So this may be a bit quick, and I don't want to. It's kind of hard to present like this, but I just wanted to give you some flavor about how we can estimate these conditional expectation analytically, which is useful if we want to do estimation, let's say using time series data. We want to calibrate the model over time to lots of data, because we have the cross-section of the entire surface across 3 maturities and 13 maturity dimensions every day for 2 markets. So if we want to calibrate this model in real time to all these prices, it's useful to have an analytic solution. We could, of course, simulate and estimate these prices via Monte Carlo, but it would be much, much more cumbersome then to calibrate the model parameters over several years of data to these 2 markets. Again, 3 maturities, 13 strikes per maturity. So that's why we find it useful to have an analytic solution. So once we have the credit default swap index, we can do the same thing for the equity index. Remember, every individual firm's price is obtained as an option on the underlying asset value with strike equal to the outstanding debt, essentially a compound option. Then we can price the index as a sum. In this case, n will be 500 for the S&P, but we again use the Plasticek homogeneous pool, and we let n go to infinity, and then we can price this average as a conditional expectation, where we condition on the state, and we can do some algebra, express this conditional expectation as this expression below, which again depends on computing expectations of indicator functions, for which we can rely on the same multivariate affine transform technique I mentioned before to get analytic solutions. We then go to the next level. Now that we have an analytic expression for the credit default swap index and for the equity index, we can now price options on the credit default swap index. So the call option on the index would have this classic hockey stick payoff, right, where there's a strike K, which is the strike at which we agreed at date 0 to buy at the maturity option. The maturity option is T0. We agreed that we would pay K to buy insurance at a price that will be then determined based on aggregate market conditions. The aggregate market conditions will be a function of the common state, A and omega. That is little x here, right? And so you can see the classic payoff of a call option here, but of course the classic payoff of a call option applied to the credit default swap index, the distribution of which we have found on the previous slide. And you can take the equation you have on the previous slide, plug them in here, do some algebra, and then you can see that pricing the credit default swap index requires, again, pricing conditional expectations of that form. It's one more layer, so we have one more indicator. But again, you can use the same methodology, just with more indices, but and one additional integration. But we can use the multivariate affine transform that I tried to give you some overview of to also find analytic expression for these conditional expectations. Okay, so we have now everything. We do the same for SPX options, but I'm going to skip this in the interest of time. So we have now a model. We have analytic formulas for everything. And now we want to calibrate it and see what the model says about what is the relative pricing of equity volatilities versus credit volatilities. So I'm going to first show you what happens if we calibrate the model without stochastic volatility, and then I'm going to add stochastic volatility to see what that does. And I have about 20 minutes. So the way we calibrate it is we set a few parameters that are not easily identified. We set them to some numbers. So for example, we're just going to first consider just the model without idiosyncratic, where the idiosyncratic jumps are jumps to default. So we set a large jump number for the jump size, and we just rule out the fact that there's some distribution of the jump size. This is just for make our life easier, but we could extend that in future work. So we're only going to estimate essentially the intensity of idiosyncratic jumps. We set bankruptcy costs based on estimates from the literature. So we're left with calibrating 10 remaining parameters. We're going to make sure when we calibrate the model to at all times fit the level and the slope of the CDX. So we're going to fit the underlying, both the 1 year and the 5 year spreads. Again, it's important to fit both the level and the slope, because the slope has information about how much the market sees is the likelihood of a short run jump versus the long run credit conditions. So we find it useful to calibrate to both short and long term credit spreads. We're going to calibrate to always hit perfectly the level of the S&P 500 index. And we're going to calibrate to the S&P 500 average dividend yield we get from Compustat. And we always calibrate to the average short and long-term debt of the firms in the CDX. And so when we do that, then essentially we have 4 degrees of freedom left, which are the parameters of the state vector, to fit the entire surface, 13 strikes and 3 maturities, so 39 prices. So we're going to calibrate in the first experiment only to the equity option vols, and then we're essentially going to price the credit options out of sample and see how the model is able to explain the credit options relative in some sense to the equity options. First, this is parameters. I'm going to jump this. The parameters don't vary too much. They seem fairly reasonable. But first, I want to show you a sanity check. So, if we were doing out of sample pricing, if we just allowed the model to fit as good as possible the equity options on the right-hand side, and as well as possible the credit options on the left-hand side, without looking at cross-market restrictions, could the model do a good job? And what you can see is the jump diffusion model could indeed do a great job. So this is the red line is the model, and the stars are the data. So you can see that if we just price in sample, we can do great on the S&P right-hand. And we can also do great on the CDX left-hand side. So the model has enough degrees of freedom to do a good job in sample. Okay, that's not to say that the fit we achieve that looks perfect is using the same parameter. They're using different parameters. So right, so I'm going to show you next that it doesn't do so well when you price across markets. But still, this picture is useful because it's telling you that it's not obvious that the model can do well. For example, the blue lines that you can see on both the left and right-hand side graphs, the blue lines are the pure diffusion model without jumps. So you can see that without jumps, it is the old Black-Scholes model, for example. It's actually the Merton model. So it's pricing the equity as a compound option on the underlying asset value, but without allowing any jumps in the asset value. You can see that this model, even if you try to price in sample, you have no chance at pricing the market, right? This is the prediction of the model. This is the skew predicted by the model. So it is negative, but you see it's very different from the actual skew we see in the data, right? So the pure diffusion model cannot, even in sample, match the equity option skew. It can also, the pure diffusion model cannot price the actual skew. And in fact, what's interesting, which we didn't know before we tried it, is that the pure diffusion model actually predicts a negative skew for the credit options, where in fact in the data it's positive. So the model that doesn't even get the sign right if you don't. So it's really crucial to allow for jumps to be able to match the data. Again, this is just a sanity check. So if we try to price in sample, we could do quite a good job with the jump diffusion model. But now, if we fit the model to one market and use the same parameters to price the other, then this is what we get. The top picture, top panel is the fit on the equity market. And you see we do great on the equity market across maturities. The 3 different columns are different maturities. So we do great. The model does great at fitting the 3 maturities fine. But then when we go to the lower panel, this is the out of sample fit of the pure of the jump diffusion model without stochastic volatility to the credit options. And what you can see is that the model does actually a good job at fitting the shape. So the skews are this is data versus this is the data, and this is the model. And so you can see that the shape is okay, but actually the model under predicts the level by quite a bit, right? And so essentially what this is telling us is that a pure jump diffusion model, if it does a great job at fitting the equity options, once you look at what is the level of the credit volatility that's predicted by the model, the model tends to predict a level that's much lower than what we see in the market. In other words, the model says market prices price in way too much risk. The market prices implied volatilities are much higher than the model implied credit volatilities, much higher. And so even though the market says the model says that the skew, the relative pricing of out of the money versus at the money options is quite correctly captured by the model, which is interesting. So of course the question is, this is for one day. If we look at over time, then we see that essentially this is the over time fit. You can see that the first panel just shows that we're matching perfectly the entire history of credit on the left-hand side and equity SPX on the right-hand side, that we're fitting perfectly the at-the-money CDX volatility levels, that we're fitting perfectly the at-the-money SPX volatility levels, which is here, but that we have a problem in fitting the level, there's the difference in levels between the market at-the-money implied CDX volatility and the model implied at-the-money CDX volatility. It seems to be quite a difference here between those two market predictions. And we can look over time at the absolute difference and the relative difference, and we see that in relative terms there seems to be somewhat of a decrease over time. That, in other words, if you call it mispricing, or the error in the model seems to be going down over time, but it's still not the gap hasn't closed by the end of the sample that we have. Then we can look also at various dynamics, the empirical dynamics that we predicted, and there actually the model does quite well. So the changes in terms of predicting changes, the model does quite well. So it only has a problem really with pricing that absolute level. in the interest of time, I'm going to. So what could explain the mistakes we see here? So we in the paper we pursue the mispricing, or essentially the fact that the pure jump diffusion model is not able to match the level once calibrated to the equity side of equity markets, is unable to predict the level of the volatility in the credit side. So we look at various things. We look at both within model issues. So is the model misspecified? And then I'm going to offer a few other explanations, and then I'll let you decide what is your favorite explanation. So first of all, obviously, the model has many assumptions. So we look at the large homogeneous pool assumptions. So we push n to infinity. In fact, on one side we have 500, on the other side we have 125 names. So we do some simulations to see whether this could explain things. Actually, what we find is this actually tends to go in the other direction, because that could actually go in the right direction, because 125 names means more dispersion, and so it could actually explain more risk on the credit side than on the equity side. But actually, quantitatively, we don't find that it's able to close the gap. The model assumes a lot of homogeneity. So, for example, we assume the same average debt levels, the same initial leverage. In fact, we see in the data that there's quite a cross section. So we generalize the model to allow for different levels of different groups of firms with different initial average leverage rates, average leverages, and we match those different groups to the data, and we find actually that this actually goes in the opposite direction. So it actually there seems to be more dispersion on the S&P 500 side than on the credit side, which actually would go in the opposite direction. Then we add stochastic volatility, and there again, I'll just show you one picture if I can. Yeah, so if we add stochastic volatility, so what we do is we take the parameters that we have and we fix rho, and we now add vol of vol. So we move vol of vol away from 0, and we move vol of vol to 0.2, 0.4, 0.6 for this experiment. And we look at what is the implication of having positive vol of vol to the smile. And what we find indeed is that the model will do a really good job at fitting the equity, obviously. So adding stochastic volatility does not deteriorate the fit on the equity side, but it does tend to close the gap on the at the money level. So it does seem to help in predicting higher at the money credit options. And the reason this seems to be very important, which initially we hadn't really thought would be that important, because we thought this is a complex model where the underlying asset value of the firm affects both the equity and the debt, because both equity and debt are options on the underlying asset value. So we thought if you're adding vol of vol, it should make both the equity more volatile and the debt more volatile, and therefore should affect both. But it turns out that the impact is larger on the credit side. And just to give you a quick intuition of that, about that, why that's the case, the reason is that if you think about the equity is a call option that's on the asset value of the firm that's highly in the money, right? Because when you buy an index on the S&P, you're buying an equity on investment grade firms. So this is a highly in the money option. That means it's going to have a very high delta, but a very small vega, right? So its sensitivity to volatility is going to be very low. Whereas if you think about the credit side, that's a put that's highly out of the money for these investment grade firms. They typically have low leverage. And so this put will have low delta and it will have a delta and a vega that are of the same order of magnitude, which means that adding vol of vol will have much more impact on the credit spread on the put volatility than it will have on the out of the money put volatility than it will have on the in the money call volatility. And that's why adding vol of vol helps in closing that gap. Okay, so let me go back to where I was before. Sorry. I'm missing some online. Sorry about this. I'm not Okay, so this is what we do. So it does seem like adding stochastic volatility, which is helpful in closing the gap. And so right now we're actually implementing an estimation to go through the whole sample to show how this helps if we actually estimate the stochastic volatility process from the data, see if that can close the gap significantly. In the few minutes I have left, I want to just talk about a few other things that are important. So, for example, the other thing which I think is very important to understand a bit better is, when we see that gap, again, this gap would be even more surprising if we had the exact same underlying indices. But of course, we can always think that maybe there's a gap because in one case we have 500 underlying stocks, the S&P 500. In the other case, we have 125 CDX constituents, and they're not exactly the same. And so the question is, what 125 sounds like a large diversified portfolio, but maybe it's still very far from infinity. And so maybe the fact that we have not exactly the same constituents could explain it. And maybe if maybe the constituents of the 125 CDX basket are much riskier than the constituents of the 500 S&P firm. And so if that's the case, then this could explain the fact that we see that the implied credit level on the credit side is so much higher than on the equity side. And so what we do is we look at the risk characteristics of these two baskets, and we try to say, are the risk characteristics clearly different? Is it clearly the case that the credit basket is much riskier? And we do this in several ways. We look at, for example, leverage. So is the distribution of leverage on the CDX side much riskier? So do we see much more highly levered firms? And it doesn't seem to be the case for what we have. So if we look at both median and averages, then we see that they're fairly similar. And if anything, we see much more dispersion on the S&P side. So the S&P has many more firms with no leverage, so zero leverage, and many more firms with much higher leverage, so non-investment grade, non-safe quote unquote firms relative to the CDX levels. Then we also look at the distribution of ratings. So our rating as the average rating and the dispersion of ratings on the S&P 500 side very different than from the CDX side. And we find that again from both the median and the average, the ratings are quite similar. In fact, very similar, and the distribution is actually more dispersed on the S&P 500 side, which would actually lead us to think that it would look riskier from that perspective. Then we look at the underlying volatilities of the firms, both the asset volatilities, both the idiosyncratic and the systematic components. And we say, well, is it the case that the typical firms on the S&P side are riskier than on the CDX side? And again, we don't find that to be the case. In fact, if anything, it's the opposite again. So both of these, of course, there could be other dimensions of risk that one might consider looking at, but at least from those characteristics that we looked at, leverage, rating, distribution, and systematic and idiosyncratic asset volatilities, we don't find very clear evidence that the CDX basket is riskier than the S&P. If anything, we find kind of the opposite. So that doesn't seem to be sufficient to explain this difference. And another potential reason is that that there is differences in demand. So if there's some segmentation between these two markets, if there's a very strong demand for one product, then this could explain why the price of that product is higher, and therefore the implied volatilities that we back out are so much higher. And we do find of course, it's hard to get hard data here and you have a smoking gun evidence, but we do find a lot of talk among practitioners that the reason this market expanded so much after the Lehman crisis, and is likely as a result of Dodd-Frank, that the banks had a lot more management of their exposures to do, and a lot more regulatory capital restrictions, and that these credit options actually can be viewed as risk mitigating trades for them. So in other words, if you're a bank and you want to manage your risk, and you go to regulators and say, I bought credit options, and therefore I should I have less risk on my bond portfolio, that credit option is receivable as a risk mitigating trade. Whereas if you told them, well, the credit option is really the same economically as a put option on the stock index, so I bought a put, that actually would not be receivable by the regulators who view sort of want to separate equity products from debt products. And so even though, of course, from the point of view of a structural model, a put on the stock is very similar economically, gives you the same type of protection as a call on the credit spread. From the point of view of regulators, one would be viewed as a risk mitigating trade along to mitigate the capital you need to hedge a bond portfolio, whereas the other would not be receivable. And so this may be one story for why there's a lot more demand in recent date for these CDX swaptions, and that this demand may be in part regulatory driven. And that might drive a wedge between those two prices. Of course, that's not sufficient. You need a reason why investors are not picking up the trade, why hedge funds are not willing to to buy one and buy the expensive one and sell the cheap one. So you need some slow-moving capital in addition. But if that's the story, and that's going to be my last slide, then you would expect that there would be actually abnormal profits to be made by trading one versus the other. And that's the last thing we do in the paper. We say, well, if that gap that we document using the structural model between the volatilities on the credit side and volatilities on the equity side, if that gap is really there and it's really a mispricing as opposed to a model misspecification, because it's hard to reject that it's model misspecification. But if it is not model misspecification, then that means that the strategy of selling volatility on the credit side should be more profitable on average than selling volatility on the equity side. And so that's what we do. We consider just a strategy where every day we're going to sell straddles. So we're going to sell delta neutral call and swaptions on the credit side and call and puts on the equity side. So we essentially sell implied volatility, if you want. And then we just hold it for a day, and we make sure that we're always delta neutral by rebalancing our trade every day. So of course, there would be high trading costs associated with that, but we're not interested in trading costs at this stage. We just want to figure out whether the level of volatility seems to be higher in one market versus the other. And what you see is that if you sell credit, then if you look at the equal weighted Sharpe ratio on this strategy, it's 1.744, whereas the equal weighted Sharpe ratio on selling volatility on the S&P 500 side is 0.65. So you can see that indeed, selling volatility seems to have a much higher Sharpe ratio on the credit side and on the equity side. And this is if you did it in the full sample. If you did it without the COVID-19 crisis, which had added a lot of volatility, you can see that the results are also dramatic, that the Sharpe ratio would be 2.3 selling volatility on the credit side versus 1.1 selling it on the equity side. So much higher Sharpe ratio for selling volatility on the credit side, which is again consistent with the results being not only driven by model misspecification. And then of course you can look at the long short strategy of consisting at selling volatility on the credit side and buying it on the equity side, right? And so here again, you find very high Sharpe ratios, although what's interesting is the Sharpe ratios of that strategy are not higher than the Sharpe ratio of just selling option outright. However, the skewness of these strategies is much more interesting. So you can see that the strategy of selling vol typically has negative skewness and quite highly negative skewness, whereas the strategy that consists in selling vol in market and buying in the other has much better properties from a skewness perspective. The graph on the last graph shows that. This is just selling outright vol. You can see that you have these on average profitable, but sometimes you have quite significant drawdowns. And you can see that the strategy that consists in selling vol in one market, buying it in the other, looks like much closer to quote unquote an arbitrage. Of course, it's not an arbitrage, there's risk there, but it looks like a much better strategy. Again, suggesting that maybe those two markets are not perfectly aligned from a risk pricing perspective. All right, I'm out of time. I thought I would be finished in 1 hour and 15. I went a bit overboard, but I'm basically done. I hope I've given you some overview of this fairly new market on credit default swap options and showed you that there might be some interest in developing a model that was consistently pricing those two products so we can compare readily the information that we get about volatilities from credit versus the information we get about volatility from equity. We've calibrated this model to these two markets and found that without stochastic volatility, the two markets seem to predict different levels of implied vols. The volatility priced on the credit side seems to be much higher than the volatility priced on the equity side. It could be that, of course, we have not perfectly well specified model. So there's a lot of, I think, future research into improving the model. For example, we find that adding stochastic volatility goes some way in closing the gap. But we also think that maybe there's more to it in terms of, for example, maybe different clientele effects. And the evidence we have on the fact that Sharpe ratios from setting volatility on the credit side has much higher Sharpe ratios than setting on the equity side seems suggestive that the volatility is not consistently priced across these two markets. Thanks for your attention. And I hope you were able to see the slides after you downloaded them a bit better.